after 8 years, he will have enough money, enough fund to buy the assets back, or to buy the 40% back. And when he buys it back, it may be, this is his profit. For the first 8 years, he's not making a profit because you only have very small asset base, but in 8 years, he will have more asset base. Or he can do something slightly different. He can agree with the other partners who took murabaha, mudaraba, musharaka, 20 million and 20 million and 20 million. He agreed with them that after 8 years, when we come to redeem the sukuk, when we come to pay the 40 million sukuk, you buy at today's price, not later. You buy 10% of it, and he buy 10% of it, and he buy 10% of it. So they make the money available after 8 years to redeem or buy back the sukuk holder. That way, each investor who put 20 million in the year 2000, who put 200 or 20 million on the year 2008, his asset become not 20 million, become 28 million. So he made a profit for that much, and they got rid of all the sukuk holders, and the project become owned by only 3 corporations. They can deal with each other, they can sell and buy and so on. They can put it in the stock market, which can be traded. And that is the value of the sukuk. Now, what is the advantage of the sukuk holder certificate? Those people who buy part of the sukuk. First of all, the advantage on bonds. When you buy bonds, you buy certificate value of $1 or $10 or whatever. But what happened to the company? Sell that bond. If they gone bankrupted, you've got nothing. But with the sukuk holder, it's different. The sukuk holder, their one main contract element is if the business or the transaction or the property or the hotel did not make the expected return or did not or go bankrupt or whatever, the first people who get paid is a sukuk holder. So they sell the assets and they get the money back. And that could be it's advantage for the sukuk holder, but it could be disadvantage to the other partners. But that's how it's done. In any business you go in, there is a risk. And in particularly with Islamic finance, the risk is shared. You remember in the earlier slide when I say always put back risk sharing? In Islamic finance, the investor take part of the risk. And that's basically what we explain to economists and stock market and so on. I'll just carry on the type of products. Then the other ones, there is Arbun, Qard Hasan. Qard Hasan means interest-free loan. Not many people do that, but they consider it as a charity. Then Tawarruk is selling your asset and buy it back. It's a contract which is not have a lot of controversy about the way it's done, but still operating. Then we have a home financing, Musaka'a, Muzara'a, which is a type of contract which is used for agriculture, and so on. So, Islamic finance contracts or Islamic finance tools, if you look at this number of contracts, you find it cover all aspects of trading in the global market. In fact, if you research further in any one of these, I'm sure some students here will do that, if they research further, they found, for instance, a hire purchase contract, HP. Where is it extracted from? It's basically Murabaha contract. And that's the base of it. But what happened to the HP if the base of it from a Murabaha contract? And this is very important for you to understand with Islamic finance. You have a Murabaha contract, which is give a right to the two parties to speak and understand the terms and conditions of the contract. They have both rights to negotiate. The contract to be transparent. No one party dictate condition on the other. But what happened when in HP contract? Because HP contract done by by banks, mainly. So the bank take, like what I said in the credit card, the bank take the contract and change the terms and conditions to his advantage. Gradually. It doesn't do it in one, they do it over 200 years. Every time they change something to their advantage. To the extent when you take an HP contract, compare it to Murabaha contract, you find it's extremely different. And it's only taking part of the investor. And what the investor done, or the contract, what he do? He pass on his risks to the other party. So if anything happened to the contract or the goods or whatever, the person who take the contract had to pay from it from his different assets. While Murabaha contract specify, now let me take the HP contract. The HP contract say for buying a motor car. And the motor car is the one which you get it for HP contract. So what happened? They will say, okay, the car is broken or stolen or no longer is available. The HP company will say, well, look, I don't care what's stolen, no, you had to pay for it. But the Murabaha contract, it doesn't. The Murabaha contract, if the asset disappeared, who bear the loss? The money supplier, not the borrower. Because why do you go and have a Murabaha contract on a car if you have the cash? If you have the cash, you don't go into another contract, you go buy it on a Murabaha arrangement. So when you look at socially on the principle, you found that the person who will buy the Murabaha contract is a person who cannot afford the goods in the first place. So if that goods lost for any reason, who bear the losses? Bear the losses the finance. Because he actually built up certain profit on the contract to overcome any losses coming from different contracts. But what the HP contract is, he making the profit the same, but he take more profit by getting you to supply the value of the car from any other assets you have. If your wife has the jewelry, you get to sell it to pay for the asset. If you have a house, you go and sell it and pay for the asset. And that is the difference between Murabaha contract and an HP contract. So when we're looking at Murabaha contract, we're looking at the two parties fairly, ethically make arrangement to buy and sell a thing. It doesn't mean that you are the asset or the money owner or the investor deprived from making profit. No, we want you to make a profit, but ethically, fairly, not abusing them, not take advantage of the poor, and so on. And that's why you find all this terminology of the contract, or Islamic tools or Islamic contracts, each one of them look at this particular fairness of the contract and look at it again. It's like when you go in to buy a house and you find the house is, the windows are bad, the floor is in there, the damp going here, and what you decide, say, I can't repair that. It's too much effort to repair it, and whatever you repair it, you cannot get any good job. So what you do? Demolish it and build a new one. And that's why Islamic finance over the last 10 years, as you can see from the earlier statistics, grown is because it takes the contract from the base and then build a contract fairly between the two parties. And that's what's happened in the most capitalist society. There is a bank, and the bank basically will transfer the risk to the other partners. So if you look at this risk for conventional bank, the main important risk on the conventional bank is credit risk and interest rate risk. What is the credit risk? It's the money risk, basically. So if anybody borrow from the bank, they go under the credit element of the bank. So the credit column in the bank, they have two, one borrowing and one repaying. And the more the asset the bank had, or the more cash the bank had, the more borrower he wanted to have. So if you are a good customer, I'm sure most of you like this, you're a good customer, you don't borrow much, You find the bank manager every other time they send you, would you want to buy a new car? Do you want to buy a new house? You know, we have the money available, we can get you this, we can get you the other. It's because they have surplus cash, you want to get it. But what they do, the credit risk is. The credit risk is basically the bank will pass on their credit risk into you. So they will charge you the 100 ringgit, for instance, or 100,000 ringgit, and they will charge you, say, 12% fixed interest. What is 12%? It is the profit which the bank can make, but at the same time, he put it on the debt. So you are not only owing the bank the 100,000 ringgit, you're owing the bank in 1 year the 100,000 plus 12%. So what the bank has, he sold the money to you, or lended the money to you, and he is sitting there putting leg over leg, going to his yacht into the whatever, and he collected 12% from you. You go and sweat and work and whatever, you go to supply it. And that is what we call it in the economic terminology, a credit risk which is passed on to the client. There is another risks which involve like operation risk, foreign exchange risk, reputation risk, rate of return risk, equity risk, and so on. I'm not going to go in details of them, but basically I just want to highlight the credit risk, which is mainly the bank pass it on to the client because the client is paying fixed interest. I go back to very beginning, the first slide if you remember, and that is what we call it riba. And riba is prohibited. So we're looking at another way of making the bank to make money, making the client to take advantage of the money without getting into muharramat, without getting into haram. And I'm sorry I didn't explain earlier when I was talking about riba, but let me explain it now. Why Allah prohibits riba? Any of you can think why Allah prohibits riba?
Because of greed, the other side. The prohibition of riba will release resources, and the risk sharing will increase the shareholding.
Exactly, this is the point what I'm trying to make. It's the risk sharing element. It's because riba basically transferred the risk of the lender into the borrower. And that's why when I came back, remember when I said, well, we always talk to the economists about, we talk about risk sharing, it's because this is the terminology they understand. But they don't understand riba.
Would you not also call it risk diversification
Yes.
rather than only risk sharing?
Well, risk transfer more or less. Diversification is sharing or passing the risk to the other party. It's exactly the same. But it's basically, you call it what you like, but I'm transferring all my risk into you. So you bear all the losses, but I bear all the profit. And that's where the riba is not fair. So Allah did not prohibit riba because the sake of it, He prohibits riba because it's not fair. And that is basically what basically there. And if you remember, I'm sure all of you know that, there is no economic system set by the Quran, nor a system Prophet Muhammad in his hadith or his 23 years of message gave an economic system. So what did he say? أنتم أعلم بحاجتكم، أنتم أعلم بدينكم، أنتم أعلم بدنياكم. You set the economic system in accordance to you, to one will suit you. As long as you avoid riba, and you avoid gharar, and so on. So they just, a prohibition. Now the prohibition I mentioned to you earlier, and the contract tools and all that, none of this in the Quran, none of this Prophet Muhammad mentioned. They all an initiative by the scholars after that, when they looked at the depth of the Quran, looked at the hadith, looked at the sunnah, look at the way it's done, look at the environment at the time, and they come up with this type of the contracts because they thought the contract is that is what it's been traded to. And these contracts are devised and developed, I would say, average, I'm not saying exactly this, about 1,000 years ago. And what we need now in the 21st century is need a creative, we need a guys and scholars and educated people who come up with the tools, which is to meet the 21st century. We still bring out the contracts from 6th century and 7th century, and we apply it now. It's because we run out of ideas. I cannot create a new contract, unfortunately. Need someone to be living and working in the capital market and the environment to create a contract. Now, just really to say, having not applied the principle of Islamic finance, which is goods have to be based on assets. I'm just going to recap. Avoiding riba, avoiding gharar, deception. What gharar here mean? I meant to by deception is I tell you something which is I don't tell you what is default with it. I sell you a car for 10,000 ringgit, and you take the car and say, oh, the body is clean, the seats is okay, the engine running, and I take you for a ride, and I sell you the car, and you ask me, anything wrong with the car? No, it's perfect. You can see what it is. You pay me the 10,000 ringgit, you go. A week later, you found the car. You take it to the mechanic. Oh, don't you know? The gearbox had to be changed. This is the deception, which is I hired a default for the goods I'm selling. Take it into a bigger scale, bigger market. Even if you buy a commodity, they don't tell you that this commodity coming, they sell you a wheat produced in Southeast Asia. But they didn't tell you that in, I don't want a name, otherwise somebody will not like what I say. They don't tell you that X village in the Southeast Asia, they have worm, and they affected all the wheat. And when you have a delivery, you find that this delivery cannot be sold because it have some kind of worm which is affected the crop. And that is what you call a deception, gharar, which is a gharar by you. Yeah, I don't tell you what is wrong with the goods I'm selling.
Can you ever do that perfectly? Because you have right there.
Yes, you can do it. And that's what Hadith Prophet Muhammad said when he walked in the market one day and he found somebody putting a lovely fruit and he took one and turned, he said, he found one is bad. Oh yeah, but that is the same. The trader at the time, he made a gharar to the people that his goods is nice and perfect. And when you come, you buy bring to the bank, you take this one as it is and put it there, it doesn't show the other side. And what Prophet Muhammad said, Man gharrana falaysa minna. And that is basically what happened. I just want to jump into something very important. Having applied Islamic finance tools, having applied Islamic finance principle, we will be eventually avoid the crisis which is the market, the global financial crisis has created. I'm just going to jump this because I think the time is running, and I want to show you a video, and then I'll talk to you after the video for a while. Just give me a second. This video is here.
Crisis. It's a worldwide financial fiasco involving terms you've probably heard, like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, believed to be the safest investment. But in the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit, makes great deals, and grows tremendously rich, and then pays it back. The investors see this and want a piece of the action, and this gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment banker who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices: safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in, and the bottom tray may not get filled. This makes the bottom tray riskier, and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so that credit rating agencies will stamp the top slice as a safe AAA rated investment, the highest, safest rating there is. The okay slice is BBB, still pretty good, and they don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. he sells the okay slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered at the homeowner's default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the turning point. So, just like always, the mortgage broker connects the family with a lender and a mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker, who turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone. It makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they didn't care. They were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means he forecloses and one of his monthly payments turns into a house. No big deal. He puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they plummet. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000. They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country, and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy, the investor, to sell his CDO, but the investor isn't stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bond. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bond, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bonds. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. The investor calls up the homeowner and tells him that his investments are worthless. And you can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
Now, did you see the basic elements which is led to crisis? If you look at them from one, from beginning one by one, you will find majority of them, or all of them in fact, is because selling either debt or selling something you don't owe, or selling something value a lot more than the actual value. And when you look at Islamic finance, when I try to explain earlier, Islamic finance based on assets, so the value of the asset had to be maintained. And in this case, when you're looking at the houses problem, the houses reached 90,000, while the mortgage alone is 300,000, so it must be the borrowing, or at the time the value of he bought the house must be 350 or 400,000, whatever, and therefore the actual value of the asset is not worth the amount of money it's been given. But if you look at it from the other way, if you're going to buy a house with your own money, what will you do? You will value it according to the value of the market, rather than a value of what the book's all about. The other problem, the COD, it's obviously selling the COD to investor and another investor and another investor without actually selling any of the assets. You're selling the debt. You're selling the debt. So what happened in the financial crisis when it's cropped up in the year 2008, 2007, November 2000? The first thing happened was the announcement of Lehman Brothers Bank was bankrupted. And Lehman Brothers Bank was one of the biggest banks selling default assets like this, derivative product, and package it in a format of selling assets which is worth nothing. And all the investors, including banks, central banks, a big investment company, lost with Lehman Brothers. The financial crisis created because basically the tools of of risk sharing, of selling value product, which is value the asset you're selling into, are actually not maintained. Does that give you an inside vision of the growth of Islamic finance, who has been growing that far in the last 10 years? And does that give you an idea of how you're going to see the Islamic finance in the next 10 years, when when the people learn from their bad crisis, financial crisis and so on?
Well, what I see is that the economy is partitioned into two kinds of assets. One is a financial asset, and the other is a real asset. And the amount of financial asset has been growing and showing itself in the GDP. That whereas the amount of assets which are the real assets has not been growing. And hence there is a dealing between the real assets and the financial assets. So growth during those crisis time is essentially because of the capturing of the financial. But the financial things are subject to those kinds of problems, that you are really supporting a huge debt by a very small amount of real money.
You're absolutely right. That's exactly the result which is reached here. I'd like to go further to explain how the credit crisis occurred. This is one part of it. There's obviously a lot of other parts in it, but I think the time, what time do we have? The time is gone now. Do we have time for question? Some questions?
Maybe that's one question or two.
I have a question.
Okay.
Is it okay now?
Can I just say something before?
Yeah, sorry.
The PowerPoint is available on to download, and you can download it. The remaining PowerPoint is showing the crisis curve. Can I just, before your question, just very quickly conclude my lecture?
It's your problem.
Just like to conclude that the economy and religion do not mix. From my saying, from my presentation this morning, I am sure you reached this conclusion. I reached that conclusion many years back, but take a while to put it into perspective like this. Islamic finance is a global financial system. It's not a regional, it's not for Malaysian, it's not for American, it's not for Egyptian, it's all for the global system. Islamic finance is an economic system based on a risk sharing. And this is a very important issue when you talk to economists. Islamic finance is not a religious system, it's open for all people, Muslim and non-Muslim, to take part. Islamic finance is a system of making money ethically. It's not to make money. It's if you have a pound, if you have £100 invested in your deposit account and have 1 year running in with the £100 in, you have to pay zakat on it. If you use this money in trade, you don't pay zakat on it, you only pay zakat on the profit. And that is why encouraging the circulation of money, encouraging economy. Islamic finance system is of making money. Islamic finance is immune from financial crisis because of these 4 points. It's prohibit riba and gharar, it's allow risk sharing, it is asset-based system, so you don't sell something you don't own. It is a transparent, which is when you can see the what you're buying, what you're selling. Therefore, I conclude by saying Islamic finance will be, inshallah, the economic system for the 21st century. Thank you very much. Well, the gentleman here first, sorry.
Yes, actually my question opens up a whole Pandora box of questions, but I will not get into all that. I will simply start from where you start. Economy and religion do not mix. To which I completely disagree. I hope you will take this into the spirit. The reason is that if you say riba and trade, where is it coming from? It is coming from the Quran, right? So the ethics of the trade as against the deprivation of riba is created in the Quran. See? And so the nature of ethics and the nature of transformation, that is economic and financial transformation, is coming out of the Quran. But with a given law that must be followed. This law is not, supposing that law exists with all the different kinds of systems that we face, then what is it really to go to Quran, find certain kind of sunnah of Allah, and also the guidance that is given to the Prophet, sunnah of Rasul? Why? What is the need? There is a specificity. And what is the specificity is something that must be agreeable between every party. Something which is called global ethics, something which is common to ethics. What is that thing? This is a very big scientific issue, but I'm not getting into those kind of things. I'm just going to tell you what is the Quran telling you. On what do you base your concept of participation, your concept of ethics and morality, right? Risk sharing, whatever you say, right? It is Tawheed. Oneness of Allah. Okay? This is the foundation, and this is what we call epistemology. See? So the epistemology of the Islamic finance and economics and all this come from an epistemology. The epistemology of oneness, unity. And this unity really creates a unity between religion and economics. And this is where I differ. Because then if you do that, then inside my economic dealings is a value. See? Supposing I quickly give you an example and stop there. Okay? Supposing you find a farmer who comes from back from his work in the evening, finds a beautiful fruit on the tree, takes it out, and takes it home and finds that is a cancer-creating fruit. So next day he wants to get it out in the marketplace. What will he sell for? There is no substitute for it. So it is a national monopoly. Hence, you will say, well, I'll sell it for a very high price. What is the value in it? The value, the entire value, if you say its price, then you can charge that price. Is that really the value? The value that is in the cure disease is not his value. It's placed there in Allah. See, this thing will find its meaning when he brings it out in the free market system. So essentially, therefore, in all of our transactions, see, be it economic and scientific or whatever, there is a value which is very intrinsic. This intrinsic value is yours and mine. It is everyone's. Hence, therefore, if you take that into account, it is to ascribe the fundamental principle of Islam. And it is the universal principle of Islam, of Tawheed. Tawheed meaning the unity of knowledge. See? Hence, therefore, if you take this into account, then the very first element that you have given us, economy and religion are separate. They are not separate. They are integrated. They are learnings. They are organically unified. See? And this is the discovery that we got research. And that is where the Islam, anything which is Islamic, begins to give to the world.
Thank you very much. I note your point, and we agree to differ. I'm talking to 6.8 billion global people. They are not Muslims. And when you start to talk to them about the depth philosophical argument in Islam, they will say, goodbye, thank you, you do your religion, I'll go do my trade.
It's a
I'm just,
postulation.
yeah, can I just and that I'm talking to a people which is simplifying the ethics and principle of Islam in the contract and day-to-day dealing. I can sit with you, argue with you all day with another scholars of the same caliber. But if you take an average person who buy and sell and trade, you will not sit in the room for 10 minutes. You will get bored. You will not understand what you're talking about. We have to go down from the philosophical argument into the level of the trader, of the banker, of the market trader, into the small investor, and explain to them the principle and the ethics of what Prophet Muhammad put to us. Made us Muslims. Why we are Muslim is because we reflect a good deed and good trade. And that is, yeah, exactly. That's what we build from. We're not building from the difficulty and that's why I said earlier, when you look at the Quran, he did not set an economic system. Left it to you to set your own in accordance with the environment you are. Thank you very much. And the other question.
Yeah, question. See, one constraint in the proliferation of Islamic countries due to this harmonization of economic system within Middle Eastern countries, Southeastern countries, such as Malaysia, Pakistan. For example, these Middle East countries recognize Malaysian Islamic system as pure system, but more pure than Malaysia. This is one of these constraints that would hinder the progress of Islamic finance in the world. First question. Okay. Second is you talk on usury for riba. Of course, in this 21st century, I think this question of can we really have 100% products which is free of riba, which I think is quite impossible. Even this so-called Islamic credit card, there's some dose of riba usually in products. Could we have some really 100% free of riba products?
Yeah, let me answer the second one first. Yes, you're right. You cannot, especially after the world of economy developed what we are, and most of the generation right now, only people, they talk about interest. Trying to take the word interest of their calculation, you find it very difficult and impossible. But what you can do, you can try to avoid as much as you can, and gradually you go on. So by making the contract fair, offer the alternative, because if you come to stumbling block and say, well, how can I avoid riba if you don't give me anything else I can do? When Islamic finance started in Malaysia, started in 1984-85 with the Takaful Act, and when it started in 1984-85, the percentage of Islamic investment, Islamic trade at the time was 0% when it started. Now it has reached 28% of the Malaysian economy. How that reached that? It's gradual build-up and gradual transactions, and people find it, sometimes they find it fairer, sometimes they didn't, sometimes they went into it because of a fashion, sometimes they went in because the Islamic banks give them, and Islamic dealing give them more profit, sometimes they give them less profit, but whatever happened, they are a growth grows. It might be, if you give it another 10 years, it might reach another 15-20%, it may be 50%, and after that started to grow. It's because Islamic system, or Islamic banks in Malaysia, have give alternative to what they convention. And they become more profitable, giving the services they may probably will get, give alternative tools, whatever, and then they reduce their profit and gradually they build up there. So you cannot go into somebody does not know how to swim and throw him in the middle of the ocean. You have gradually to build up that. And yeah, we are not going to get free riba globally immediately, but one of these crises helps. They started to look now at, if you look at the Central Bank of America and the Europe, they started to apply some tools. They never say it's coming from the Islamic finance. They're trying to apply some tools. They're saying, for instance, well, look, the derivative product is selling debt. We have to identify the asset somehow. So we started to look at what is value. You cannot sell derivative product more than 10 times the value. 10 times is a lot. So they're coming down from 120 to 10, and you're talking about quite good improvement. And where they come from? They come from the ethics and the system presented. The first question is the application of Islamic finance system in Malaysia. Why it's different from maybe Saudi, maybe different from North Africa, maybe different. It's because they apply or follow certain schools of thought. Shafi'i and Maliki slightly different. But in general, the prohibition the same. The application can be different. And I remember one of the four schools of thoughts, I think the Shafi'i, when he was in Iraq, he did give rulings, and when he went to Egypt, he gave different rulings and different application, and he said, well, the environment in Egypt is different than the environment there. He did not dismiss what he said, but he said the fatwa he gave in Iraq was suitable for the Iraq at the time. This fatwa he giving in Egypt was suitable for Egyptian at the time. So these are scholars, human beings. They are not prophets. They are not Prophet Muhammad. Prophet Muhammad, no prophet come after him. So these scholars will make mistakes. Maybe applicable, maybe not. And what we're trying to do is to take the average four schools of thoughts and try to apply to the global economy. You might find a transaction has got a certain reference to Maliki, to Shafi'i, and so on, and that is we are allowed. And the different opinion is in our advantage, not to disadvantage.
We have just one comment, if you may.
I have a gentleman here who wants to have a question, sorry.
Yes.
Okay, thank you very much, Dr. Ali Khurshid, for the very enlightening lecture. There are a few points that I would like to comment on. Regarding some of the products that you mentioned, salam. I have seen people how they practice salam, especially in my country. They do it with farmers. Farmer came, you want to, he need money for cultivation or something like that. You came, banks, they give him the money early on, you get the money. If anything happened to his produce, they will take him and put him in jail.
In France?
Yeah,